Hey guys, so in this video, I'm going over my top 6 stocks for the month of June 2021. I've spent the last month analyzing hundreds of stocks, and this is my list of stocks that I think are the best buys right now. Be sure to watch all the way through to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow. Huge shout out to Wealthfront for sponsoring this video. So let's get started. Now, the first stock on my list is Bank of America, stock ticker BAC. This is an American financial services and banking company. Chances are you bank with them at some point in your life, and they're the primary personal bank account I've been using for many years. So right now, one share of Bank of America is trading at $42.39 with a 52-week low of $22.39 and a 52-week high of $43.26. Looking at the 1-year price chart, we can see that Bank of America was trading around $25 a share 1 year ago. Starting in November of 2020, that's when their price really began to shoot up. It's a huge company with a market cap of $363.253 billion and actually pretty decent PE ratio of 18.19 with an earnings per share of $2.33, and they pay out a mild dividend of 1.7%. Their 5-year expected price to earnings growth ratio is sitting at 1.55, and they have a price to book ratio of 1.45. Bank of America has a pretty healthy profit margin at 27.12% and a return on equity of 8.14%. Now, if you aren't sure what any of these metrics mean, I'll link my How to Invest in Stocks Beginner's Guide in the description below. It'll show you exactly what all these things mean and actionable steps on how you can get started investing. Now, coming back to Bank of America's balance sheet, we can see that they have total cash of $803.34 billion, as well as total debt of $542.46 billion. It's always interesting to see what analysts have to say, so on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are currently rating Bank of America as a 2.3, meaning it is between a buy and a hold. And the average analyst price target is $42.95, which is just a little bit over the current price of $42.39. In the last year, Bank of America has performed quite well in comparison to its peers like Citigroup and JP Morgan Chase. I've been a long-term believer and investor in Bank of America, and the returns have definitely paid off. Right now, Bank of America is not an undervalued stock. Rather, I do think that it's priced pretty appropriately, so in the short term, there's no saying where the stock will go in terms of price. However, I do know that as they continue gaining market share in the US banking sector, their price should see a long-term increase. Right now, Bank of America has about a 12.6% national deposit share, which beats JP Morgan as well as Wells Fargo, and they've actually set their eyes on 25% as their long-term goal. The thing about a giant like Bank of America is that they can leverage their size to their advantage. For quarter 1 of fiscal year 2021, Bank of America reported total revenues of $22.8 billion, which is just a bit higher than the year before. Its investment banking revenues were up significantly, while its consumer banking division saw a drop due to lower interest rates. On its next earnings report, investors are expecting earnings of 75 cents per share, which would represent year-over-year growth of 102.7%. So yes, this is a boring company, but if your portfolio is missing some of these boring giants that are, in my opinion, much safer long-term investments, then I would consider doing some more research and adding some of Bank of America to your portfolio. The next stock on my list is L Brands, stock ticker LB. This is an American fashion retailer that owns brands like Victoria's Secret, Pink, and Bath & Body Works. Right now, L Brands is trading at $69.87 with a 52-week low of $13.18 and a 52-week high of $71.99. Their 1-year price chart shows steady growth all the way from under $20 1 year ago to almost $70 per share today. Their market cap is $19.487 billion with a PE ratio of 13.97, earnings per share of $5, and a very small dividend of 0.21%. They have a 5-year PEG ratio of 1.03 and a price to sales ratio of 1.5. In terms of profitability, L Brands is sitting at a profit margin of 10.73%, and the balance sheet shows total cash of $3.9 billion. Now, analysts are a little bit mixed on this one, and they've rated it as a 2.5, meaning it is between a buy and a hold. But the average price target is $77.10, which is about 10% higher than the current price of $69.87. So the L Brands quarter 1 fiscal year 2021 earnings actually beat analyst estimates, hitting an earnings per share of $1.25 and revenues of $3.02 billion. Net income also rose to $276.6 million, and total sales were up 80% from $1.65 billion a year earlier. This was fueled by momentum across its 3 main brands and people paying full price for more and more items. Later this year, L Brands is actually going to be spinning off Victoria's Secret into its own publicly traded company. It plans to do this so that they can maximize management focus and hopefully deliver more profits. I do think that existing shareholders should likely benefit from this tax-free spinoff. As an existing investor, you would receive shares of this new entity. So yes, the price of L Brands theoretically will drop, but that drop will be made up in the new shares of the new stock that you are receiving. And additionally, for Victoria's Secret, they have seen huge increases in sales for its lingerie line as a result of its more inclusive marketing approach that targets women of all sizes. I do think that this is a smart move for business as it unlocks a lot of new untapped market that they really didn't have much business in before. And with Bath & Body Works, they've seen increasing sales with more and more people getting into at-home and personal care products. Overall, I do think that L Brands is a good stock if you want to hold long term. In the short term, I do think that we could see it drop. So if you do see that dip, then it may be a good time to pick up some shares. Either way, I do think that L Brands can beat out the competition and remain a strong company for the next decade or longer.
So let's talk about Wealthfront, which is an amazing investment platform and a sponsor I love working with. Wealthfront is a robo-advisor investing platform that uses software to build you a globally diversified portfolio of low-cost ETFs. They even manage it for you so it can be totally hands-off. Here's how it works. The app will guide you through some questions to determine your financial goals and risk tolerance, and then it will design a strategic portfolio of ETFs that's right for you. They're also now allowing you to actually customize your portfolio by changing the weights of the asset classes, as well as adding new ETFs. You can even build a portfolio from scratch if you want. So if you want to build a portfolio that's more tech heavy, or maybe you want to put more into healthcare, or you really care about clean energy, now you can use Wealthfront to build a portfolio based on the sectors you really believe in. Wealthfront offers many account types such as retirement accounts like a Roth IRA or traditional taxable accounts just like any other brokerage. This is your personalized financial advisor, except it's way more affordable and perhaps even smarter. And the app is very well designed and intuitive to use. They also help you look for opportunities to lower your tax bill through tax loss harvesting. Right now you can get your first $5,000 managed for free with my link in the description, and after that it's just a super low 0.25% annual management fee. Use the link below to check it out. Okay, the next stock on my list is Intel, stock ticker INTC. This is an American technology company that is actually the largest semiconductor chip manufacturer by revenue. Chances are you currently use an Intel processor right now on your computer. So right now, Intel is trading at $57.12 with a 52-week low of $43.61 and a 52-week high of $68.49. In the recent year, Intel's actually been pretty volatile, and you can see that 1 year ago, they started off over $60 per share, dropped pretty significantly at the end of last year, recovered until the month of April, and then saw a pretty significant correction. Intel has a market cap of $230.651 billion, a pretty low PE ratio of 12.82 with an earnings per share of $4.46, and they do pay out a dividend of 2.43%. Their 5-year PEG ratio is sitting at 2.51, and they have a price to book ratio of 2.89. Now looking at its profitability, we see a profit margin of 23.93% and a very good return on equity of 23.82%. They're sitting on about $22.4 billion in cash, and they have a very strong current ratio of 1.89. This means that they have 1.89 times the current assets as current liabilities. Now, analysts are also a little bit mixed on this one, and they're rating it as a 2.8, meaning it is around a hold, but the average analyst price target is $64.87, which is well above the current price of $57.12. So Intel is much more low-key than companies like Nvidia and AMD, which means its PE ratio is much lower. I personally do think that Intel is rather undervalued, especially when you compare it to its competition. Sure, Intel has not come out with anything drastically cool in the recent years, and as a result, much fewer people talk about them. But that also means that the price is not hiked to the moon by retail investors, which means that right now could be a good time to pick up some at these really low PE ratios. Right now, Intel is getting smoked by Apple, which by the way is also another stock I recommend, but I do feel like Intel will fire back at some point. They definitely need to reinvent their chip architecture and come up with something that competes with Apple's new M series chips. But in the past, Intel has been remarkably resilient and consistent. In fact, they've beat analyst estimates 11 of the last 12 quarters. And like I mentioned before, they are a mild dividend stock, paying about 2.5% annually, with a really low payout ratio of just 30%, which means that a bulk of the money is being invested into its own research and operations. I do think that competitors like AMD might see bigger swings in their share price, at least compared to Intel's, so if you want to ride those waves, then maybe those are more exciting stocks for you. However, Intel will be a long-term hold that pays out a nice little dividend,
grows with time and builds you slow long-term wealth. That's my prediction, and that's why I include Intel on this list of top stocks. The next stock on my list is the Schwab US Large Cap Growth ETF, stock ticker SCHG. This isn't actually a company, but it is an ETF that tracks the stocks of the Dow Jones US Large Cap Growth Total Stock Market Index. I actually talked about this on my recent top ETFs for 2021 video, but I also want to include it on this list as well. It covers 235 stocks from companies that are expected to experience higher than average growth, including Apple, Microsoft, Amazon, and Facebook. So right now, one share of SCHG is trading for $137.42, with a 52-week low of $95.85 and a 52-week high of $142. This ETF has done really well in the past year, going from just under $100 per share to where it is right now. The fund has net assets of $14.59 billion, an average yield of 0.46%, year-to-date daily total return of 6.87%, and a very low expense ratio of 0.04%. That means that for every $10,000 of this stock you buy, you're only spending $4 per year in annual expenses. That, you guys, is extremely good for an ETF. Now, if we look at these sector weightings, we can see that SCHG is especially heavy in consumer cyclical, financial services, healthcare, communication services, and technology. The average PE ratio is 36.26, and the average price to book ratio is 9.47. Their top 10 holdings include Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Visa, United Health Group, and Nvidia. So if you like a majority of these companies, then this might be a really great one to buy just so that you can have a more diversified portfolio. And looking at the performance overview, we have a 1-year daily total return of 42.45% and a 3-year daily total return of 23.27%. For most years, this fund has done extremely well, especially in the last 2 years where we saw growth of almost 40% each year. However, we did see drops in both 2018 as well as 2011. So if you guys buy a share of SCHG, it's like buying a piece of a ton of different growth stocks. Obviously, this video is about stocks that will hopefully make you money. And for those of you who are into high growth but naturally riskier tech stocks, this is a great way to diversify your holdings. I'm huge on index fund investing, and I know that choosing individual companies to invest in can be a hit or a miss. That's why I recommend ETFs for most beginners as well as seasoned investors. When you buy an ETF, you're basically in it for the long run. One reason I particularly like this ETF is that its expense ratio is a very low 0.04%. This is on par with many of Vanguard's low-cost ETFs that I also recommend. It's just a very good and cheap way to hold a bunch of companies all at once. And since its inception in 2009, it's earned an average annual return of about 16%. Of course, past performance does not guarantee future performance, but it is a good statistic that tells you how strong this fund has performed and hopefully should do well in the coming years as well. Number 5 on my list is Alphabet, stock ticker GOOGL. This is an American company also known as Google and is the parent company for the most prominent search engine in the world. Alphabet includes other subsidiaries like Waymo, Google Fiber, Fitbit, and more. So right now, one share of Alphabet is trading at $2,356.85 with a 52-week low of $1,351.65 and a 52-week high of $2,431.38. Don't let the high price scare you because you can actually invest in partial shares on platforms such as Robinhood. So we'll include my link below, and if you use that, you will get one free stock. In the past year, you can see that Alphabet has done extremely well, and it really has not seen many corrections at all. Alphabet is extremely big with a market cap of $1.597 trillion. They have a PE ratio of 31.41 and earnings per share of $75.04. Their 5-year PEG ratio is 1.44, and they have a price to book ratio of 6.87. They're also doing really well with their profitability with a profit margin of 26.12%. And they also have a really great return on equity of 23.69%. Looking at their balance sheet, we see that they have total cash of about $135.1 billion and a very strong current ratio of 3.1. Analysts absolutely love Alphabet, and they're rating it as a 1.7, meaning it is between a buy and a strong buy. And the average analyst price target is $2,739.05, which is about 15% higher than the current price of $2,356.85. It's important to know that Alphabet has 2 ticker symbols, GOOG, and GOOGL. GOOG is the Class C shares with no voting rights. GOOGL shares are Class A shares with voting rights, and hence they trade for a little bit more money. It really does not matter, in my opinion, which one you get, as both will see the same gains. So it is amazing because Alphabet's earnings per share is expected to grow 50% this year, which shows just how big of a cash cow they are. Investors love its big profit margins and history of fast sales growth and cash flow. And their balance sheet is also insane, with a staggering $135 billion in cash. Recently, we have seen Alphabet starting to buy back shares, $11.4 billion in stock last quarter to be exact, which is a great thing for investors as it reduces the supply available and drives up the price. I'm 100% dead set on Alphabet as a long-term play, but it's only because I personally believe in all of their products. For example, YouTube is a big part of their company, and I do believe that they will revolutionize content and media consumption. Alphabet's recent earnings report showed big growth, with revenue up 34% to $55 billion, much of which was from YouTube and Google Cloud. It's certainly not a cheap or undervalued stock right now, but you can actually use platforms to purchase partial shares like I mentioned earlier. Overall, I think that Alphabet will expand and grow its current businesses greatly in the next decade and beyond. They just have businesses that are too powerful and too in line with what I have high convictions in for the future. That is why I'll be continuously investing in Alphabet for as long as I can. Okay, the last stock on my list is Coinbase, stock ticker COIN. This is an American cryptocurrency exchange platform that brought in $1.14 billion in revenue in 2020, and it's perhaps the most popular cryptocurrency exchange in the world. Chances are, if you trade crypto, then you've used Coinbase before. So right now, one share of Coinbase is trading at $236.54, with a 52-week low of $208 and a 52-week high of $429.54. Coin actually IPO'd on April 14th, 2021, and since then, we've seen its price dramatically fall. Their current market cap is $61.95 billion, and we don't have any information about the PE ratio or earnings per share. However, we can see that they have a price to book ratio of 21.42, a profit margin of 36.8%, and a really great return on equity of 54.2%. They're carrying about $1.98 billion in total cash, and they have a pretty good current ratio of 1.2. There really is not too much information from analysts about Coin, but right now they are rating it as a 2, meaning it is a buy, and the average analyst price target is $395.64, which is getting close to double its current price of $236.54. Now, a stock like Coinbase is risky because 90% of its revenues is currently tied to transaction fees, and those fees can take a big hit when crypto sees a decline in prices. Really, I'd only suggest considering this stock if you are a real believer in crypto for the long term. I expect huge variances in price for Coinbase, going both up as well as down, and this is sort of going to mimic the volatility of crypto itself. Long term, if crypto becomes even more mainstream, then I see Coinbase being a really great long-term hold. Their recent IPO on April 14th saw prices rise from $250 all the way to the low 400s, before closing its first day at $328 per share. Now that Coinbase is trading in the low 200s, obviously we did see a big drop in prices. I'm going to start dollar cost averaging this stock as I feel like its price is close to a new buy point. And recently, JP Morgan gave Coinbase a $371 price target, which caused prices to surge almost 10%. Its quarter one earnings slightly missed estimates, with a total revenue of $1.8 billion and earnings per share of $3.05. For 2021, Coinbase estimates that they'll end the year with about 56 million users and $223 billion in assets on the platform, which would be 11.3% of the crypto market. I do think that as more and more platforms introduce crypto trading, Coinbase will be forced to lower its fees to remain competitive. Right now, almost all beginners start on Coinbase, and that's partly due to the fact that they have a great referral program that incentivizes a lot of signups. So yeah, I really do like that strong marketing effort. Overall, I do see fees dropping at some point to remain competitive, but if the overall crypto market grows in the next decade or more, this will not matter. I repeat, only consider the stock if you're in on crypto and you think it will do well. I personally do believe in crypto, and a significant portion of my portfolio is actually in crypto holdings. And that's why I am a long-term believer in Coinbase stock. So those are my top stock picks for the month of June 2021. Like I always say, before you invest in anything, especially stocks, you need to do your own due diligence. Do not buy any stock just because it was on this list. Rather, you should use this video as a starting point. Do your own further research for each of these companies if they interest you, and then make your own decision whether whether or not you want to buy that stock. If you guys want to get 2 free stocks from WeBull or 1 free stock from Robinhood, I'll include those links in the description below. And like I mentioned earlier, if you want a whole rundown on how to invest in stocks for beginners, I will link that video down below as well. Anyways, happy trading, and if you guys liked the video, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.